Hi there, it's Mike Smith from Hawkeye Options here, and we're in a very strange place at the stage. We had a market yesterday which really was neutral on the session and doesn't fill us full of confidence in terms of placing trades going forward, perhaps some long-term opportunities if you feel that there's more upside in this, if you feel the Fed's going to continue to pause for the remainder of the year. Certainly not a market where we would consider going dramatically short right at this moment in time. And I'll explain why that is. So if we start with the daily S&P 500 here, you'll see we had this major move down followed immediately by a major move up. And that almost created a pipe bar formation, which is one of my favorite types of bar patterns. But we obviously needed another bar above the top of this wide bar here for it to be a reversal. We didn't get that, and in fact the opposite has been the case. So what we've done is we've moved back down and tested this 2120 level, which is becoming absolutely crucial as we sort of go forward and try and work out what this market's going to do. If we want to see what 2120 looks like in terms of importance, let's just put one on the weekly chart here. If we just pop one, which will be around about this place here, and you can see how important this is. So it was resistance both in June and in April of this year. It was also resistance in October of last year, and we had this period from June through to September last year where it stuck at the same place. So it's a pretty key level in terms of where the market's at, and that's why we haven't moved through. We've had already 4 attempts to push through it without success, and that is the major reason why we wouldn't be considering to go short at the moment. Because if we look at the daily chart, well, of course we've now moved into downtrend and we've got selling volume going on here. We're likely to get that again with this bar here when the market opens. Likewise here on the 2-day chart, we've actually had selling volume in for the last 3 sessions, and we've got that on the weekly chart. So in terms of strategy selection, well, bought calls will be off, and we'll be looking to go short the market, either with credit spreads above where the market's trading now, or indeed with straight put trades. But because of that solid resistance at 2120, then that is the major reason why we're reluctant to jump into this. And because, of course, the market is so choppy. I mean, we've had essentially a down day, up day, down day, neutral day, up day, then two neutral days there. So it's very, very choppy conditions. You can see the length of the bars and the volatility intraday, even though we're trading within a 40-point range on the S&P 500. In terms of where to next, well, look, 2120 is pretty obvious in terms of a key line in the sand. On the upside, we'd really like to see 2170 before we can be seriously suggesting that we may re-challenge those highs we saw throughout end of July and beginning of August. And so we're really at an interesting place. Even range-bound strategies at the moment are feeling a little possibly more risky than they usually would, simply because of where the market is right now. It could quite easily drop the 26 points. It's 1.3% downwards. Drops that, we're below 2120. Of course, it's not that far on the upside before we'd be back within this 2180 range, which is also the key technical level to the upside. So that's where we are now, and that's why this increase in market choppiness makes it extraordinarily difficult to not only pick right strategy, but also makes any position that's longer for intraday and an intraday period more than normal risk. And so our trading tip for the day is really to manage the positions you've got open now, give them plenty of distance in terms of stops, but also hold off on the entries until we get some clarity about where the overall market is going.